understanding interest on mortgage payments. Y'all, when you buy a house, the mortgage payments, especially at the beginning, it's so sad because it's so much interest. So let's consider a monthly mortgage payment of $926.21. Monthly mortgage payment. That's how much you pay every month. So, number 5 here, how much will Jasmine pay in mortgage payments over the life of a 20-year loan? Don't overthink this. If Jasmine is paying $926.21 for 1 month, well, how do I find out how much she pays in 1 year? Well, I multiply by 12 because these two together give me 1 year. Well, if it's a 20-year loan, if I multiply by 20, now that's 20 years of payments. So the monthly payment times 12 times the number of years in the loan. So 926 times 12 times 20 gives me a total payback of $222,290.40. That's how much she's going to pay. This assumes you only make the required payment. All right, some people round up, some people, pay extra hundreds, whatever. If you pay just the minimum, that's how much you'll pay back. So how much will Jasmine pay in interest? Well, to find that out, you need to know how much she borrowed. So the total borrowed amount was $124,720. Okay, I missed that here. So how much are you going to pay in interest? Well, to find that, you take the total payback amount, right? So how much was total paid minus the total borrowed? The difference between that is the interest. So in this case, the total payback was $222,290.40. The total amount borrowed was $124,720. The difference between those, $97,570.40. That's interest. That's money that just goes straight to the bank for allowing you to borrow money. Okay, this is why banks love mortgages, as long as people make their payments. That's the big piece. All right, let's keep going. What's the ratio? Remember, ratio is a fraction of what Jasmine pays as interest to the total mortgage payment. All right, so interest, we just found that to be $97,570.40 divided by the total payments of $222,290.40. When I divide those, I get 0.438. So that's approximately 43.8%. I'm going to go ahead and just round that to 44%. That means 44% of the payments you made just went to interest. Remember that percent is out of 100. So what this means is for every $100 you paid, $44 went to interest. That's what that means. So if you say, I'm going to pay $100 on my, $100 of the payment, 44 of that went to the bank, 56 of it went to your loan. That's what that means. Each payment consists of interest as well as principal. Principal is the amount that you borrowed, right? So when you make a payment, part of it goes towards your balance, part of it goes towards interest. Only the principal part reduces the balance of your loan. So what if Jasmine borrowed $124,720 for 1 month with an annual interest rate of 6.45? How much interest would she owe for just that month? Y'all, think credit cards, because this is exactly like a credit card idea, right? Remember with credit cards, we took the carryover balance, we multiplied by the APR divided by 12 to find the finance charge. That's basically the same thing. The finance charge is just interest. So all this is. So for this example, our balance is $124,720. Our annual interest rate is 6.45%, so 0.0645. We need it to be monthly, so we divide by 12. When we get that, we get an interest of $670.37. So the first month The amount that goes to the bank in interest is $670.37. This is also why you might hear people say, well, if you're going to buy a house, you got to live there for like at least 5 years to make it monetarily worthwhile, because so much of the beginning payments just go to interest. How much of Jasmine's payment in the first month goes towards reducing the balance of her loan? Recall at the very beginning, we know that the monthly payment, so her monthly payment is $926.21. We just found that interest for that first payment was $670.37. So if we take the payment, so you write the check or you do it online for $926.21, $670.37 goes to the bank. That means your balance is going to reduce by $255.84. That's how much reduces the balance, which is not a lot when you think that your payment was well over $900. So what will Jasmine's loan balance be to start month 2? Well, it was $124,720. It reduced by $255.84. So it's now $124,464.16, which is still a lot. Will she owe as much in interest the next month? No, because as your balance decreases, your interest decreases. So every month you're going to pay less interest. This is why people say if you can round up, even if you just round up to the nearest dollar, every little bit that you pay over your minimum balance, your minimum payment, that just goes towards the principal. Anything extra goes towards your principal, reduces your carryover balance, which will reduce the amount of interest that you owe. I pay extra every month on my mortgage just to reduce the overamount, and it's not a lot, but it's just a little, because the more I can reduce that balance, the less interest I'm going to pay over time. All right, so let's go ahead and finish out this table. Now, we found that our monthly interest for month 1 was $670.37. The amount paid to principal, we took the $926.21 and subtracted the interest to find the amount paid to principal was $255.84. Then we took the balance at the beginning, $124,720. We subtracted the $255.84, and we found $124,464.16. So let's do this again. So let's refresh. How do we find the monthly interest? Well, we take our balance, $124,464.16. We multiply by our interest rate, which is 0.0645, and we divide by 12. Should be a little less, and it is $668.99. How much of that goes to the principal? Well, I take my monthly mortgage payment, $926.21. I subtract how much of that goes to interest, and now the amount that goes towards the balance is $257.22. So how do I find out my carryover balance for the next month? Well, I did owe $124,464.16. The amount that's reducing that is $257.22. When I subtract those, I get $124,206.94. And we do it again. Okay, so hit pause, try it, then come back. All right, so I showed the work below that goes with each step. So you got to take your $124,206.94 times your interest rate divided by 12 to get $667.61. You subtract your mortgage payment minus your monthly interest to get your amount paid to principal. Notice your monthly interest goes down ever so slightly each month, while the amount paid to principal slightly goes up. This is why over time, it kind of flip-flops. By the end, the majority of your payment goes to principal and very little goes to interest. So again, anytime you can pay extra for the amount paid to principal, that reduces your balance at the start of the month. That's going to reduce the amount of monthly interest that you pay. Makes it a little nicer in the long run.